Good afternoon, everybody. Good afternoon, the audience. I would like to welcome our star speaker and a panel for the day, our expert for the day. Thank you, sir, for joining us for the session today.
My pleasure as well.
So just a bit of background. Thank you to the audience who joined us today. For everyone who's joining the masterclass for the first time, this is our sixth session of the masterclass. We've done previous sessions on branding, marketing, and then we've done legal compliance. With this, we will be discussing the Finance 101 with our expert speaker. And particularly, he has, Mr. Mayank Patel has over 20 years of experience working in technology, business incubation, academics, banking, and the financial sector. He also teaches a few subjects on corporate finance, investment analysis, portfolio management, asset valuation, so on and so forth. He would actually be a guy to kind of understand business models and how to evaluate your company, what are the basics of fundraising. He also mentors startups for strategic financing and business valuation. There is a lot to learn from Sir today for the session, especially when you're wanting to know what financial models work for you and how do you look at other risk management and analysis for your startups. So I will be moderating the session for you. And in the internet, if you have questions, please feel free to put it up on the Q&A section, and we'll take it forward from there. Thank you, sir. Over to you.
Thank you so much. Let us begin finance for startups or 101. I think this would be one of the first sessions, perhaps you may be having related to finance. Now, finance for startups has a very broad spectrum. No, it can start. I can start with accounting. Also, look at balance sheet, income statement, cash flow, then funding, then looking at the terms of fundraising, VC investment, and so many things. We can also involve taxation as well as fundraising also. But I feel that when we are talking at the first time in the for startups and financing for startups, the focus should be more on fundraising, because this is one of the biggest challenge. And many times startups fail because not having adequate fund. And startups generally, in my experience, I have seen startup in the sense both the company as well as the founder of the company do not have adequate understanding of critical financial terms and processes related to fundraising. So I thought of talking more about fundraising, financing of startup in this session. Let me just share my presentation here with you. Just a moment. So finance for startup, as I said, we will be talking more about fundraising, terms associated with fundraising, risk, and potential or possible returns that individuals are looking or startups are looking or need to provide to individuals or VCs when investment is attracted. So what we are going to discuss in this particular aspect of finance for startup is we look at some of the important terms which are used in equity investment. We look at the startup financing cycle. One thing, perhaps you may have heard of it, something called cap table, but you don't know how does it look like. And so we will talk about it in two aspects, pre-money and post-money cap table. Then we'll briefly touch upon, will not go much more in detail, on venture capital process and the private placement process. And bank loan also for some startups can be a very good way of raising fund, debt fund specifically. And if time permits, we will talk again, not much in detail about valuing early stage companies and exits for the investors of startups. But my focus more is going to be on the first 3 or 4 points in our discussion. The terms that are used in equity investment, startup financing cycle, how it evolves, pre and post money cap table, and the venture capital process. We will be focusing more on this. Let us look at some of the key terms which are frequently used when startups attract investment in the form of equity. Also, let me just give you one simple thing. Whenever you feel that I need to elaborate more on anything that I'm discussing, please ask questions, right? I otherwise would generally feel that, okay, what I have been discussing has been understood well. So please ask question. I was told that there will be a separate half an hour for question and answer, but yes, we will be having that, but I would not mind if you have a question in between also.
I will be moderating and helping the participants. Answer the questions to the Q&A chat. I will be putting up the questions as well while you're speaking. This is a question relevant after every your few slides. When we can take up questions, we will be taking it up relevant. And towards the end of the session, we'll probably keep 15 minutes, which could be overall or the unanswered questions. So participants, we'd like to keep it more, participative and interactive. If you have any questions which you would like sir to answer during the session, we would answer that for you. And for the rest of the sessions, if there's anything generic, we'll take it up towards the end of the session.
Very well. I think this approach will make the entire webinar very effective for all the participants. Equity investment. This occurs when an entrepreneur, when a startup is selling part of the ownership in the company in order to raise money, to do the business. This is generally the most prevalent form of raising fund for startups. They provide equity opportunities to their partners. They also provide equity opportunity to angel investors, venture capital funds. We are going to see what they are also in the process. Okay, there is a question about what will happen in case of bankruptcy and private limited company not able to return the loan. What will be the consequences? I think we are much ahead of this question. We should be looking at this question when we are talking about the bank loan. But let me briefly tell you here. Whenever there is a case of bankruptcy or insolvency for a private limited company, the creditors, the people, the entities who have provided loan to the company, they will have to compromise on the principal and the interest that they are supposed to receive legally. So if a company has received a 100 rupee loan from a bank and the company files for bankruptcy, the bank will have to compromise on this 100 rupees of loan and the interest that it is supposed to receive. That compromise again can be based on what the financial problem of the company is, what level of bankruptcy is, what kind of assets the company has, how it is sold, and who other creditors could be. There are so many factors which will come into this. The consequences would be that on all the assets, will be it tangible assets or the intangible assets of the company, creditors would have a first claim. They will be paid by selling of the asset, and whatever remains is available to the equity or the shareholders of the company. Now, whenever we are talking about equity investment for startups, this happens in a realm called private equity. So when we use the word private equity, apparently the question comes that is there a public equity also? Yes. Public equity is all the equities or shares that you see being traded on stock exchanges for companies like Reliance or State Bank of India or ITC or any other company which are issuing shares through IPO, collecting money and listing those shares for trading on exchanges. They are the public equity domain. But startups generally raise money from private equity domain. So now, when the raising of fund happens through private equity, apparently there is no stock exchange on which the shares are traded. Hence, the shares are illiquid and cannot be easily sold until something called a liquidity event occurs. Now, what is a liquidity event? Coming up with an IPO or selling the company in the secondary market. when one venture capitalist exits a company and second venture capitalist joins, enters the company, that's a liquidity event. That's the time when shares of this startup are transacted, bought and sold, and exit occurs for an earlier investor. Let me just take a couple of questions here. Okay. The question is how we can calculate the valuation of a newly created entity with no revenue and no fund raised yet, just started with own money. So when a company started with own money, apparently the corporate regulation requires it to be start with a minimum capital. So that minimum capital would be 1 lakh rupee, for example, right? This is the minimum capital required in India to start a company. But the value of the company comes from, I would say the value of the startup comes from the potential intangible asset it would have. Let's say some kind of a technology innovation or measured in the form of patent, or even without patent also there could be technology innovation or a business model innovation, which is likely to change the way a particular problem is being solved for consumers or businesses or for government. And in the process, the startup is likely to earn money. So that potential results into the valuation for the startup, right? Somebody was saying that point 1 and 2, what is the difference? No, it is no difference. Equity investment has a two subset, private equity and public equity. So I'm just highlighting that only. There is another question that somebody is building an educational institute and not a popular choice in form, an edtech startup, and also not seeking a liquidity event. How should I pull the finance required? So if you're not, liquidity event would not be in your hand. Liquidity event would be for your investors. And you can raise funding from, let's say, angel investor or from a venture capital fund, depending upon the amount of money you want and depending upon the stage of your startup. If you are at a very early stage, perhaps angel investor would be interested. But at a later stage, if you have revenue for, let's say, 6 months, 9 months of revenue history, a venture capital fund may be interested in investing. What are the chances of illiquid shares being transferable, owned as ESOP or by the investor? See, all shares are transferable. When I'm saying liquidity or liquid shares in public equity domain, what I mean is there is a stock exchange available to transact in their share on any working day. During the timings of the exchange, you can go and sell the shares or you can buy. But in case of private equity, this transaction doesn't happen on stock exchange. That's why it is called illiquid. But you can do a one-to-one transaction beyond the stock exchange. You can transfer the shares if you are an investor or an employee with ESOP. Now, in doing so, whenever a company is raising equity financing, which is for a startup in the private equity domain, in doing so, the entrepreneur offers his own shares or issues new shares for the company. In both the cases, there is a dilution in the ownership stake of the entrepreneur or the founders here. Okay, how much equity should be diluted at each stage and round of financing? We will answer this question in due course. Please wait for some time. Right. The value of the company, again, prior to the investment being attracted, is termed as a pre-money value. And once the investment is attracted, it is termed as a post-money value. So, for example, a startup may be having a valuation of 2 crore, and it may be trying to raise investment of 1 crore. So the pre-money valuation is termed as 2 crore and post-money valuation is termed as 3 crore. And in the process, you can see that when 1 crore fund is raised, 33% of the stake is offered to the investor who is investing 1 crore. Investors also usually like to invest in startups through something called preferred stocks. Now, preferred stocks or preference shares, they carry certain preference over the ordinary shares or over the shares of the founders. So what is the preference here? So when the company, if the company doesn't meet the success, commercial success, if it needs to be diluted, liquidated, in that case, preferred shareholders will have a priority of claim on the assets of the company or the proceeds of the sales of the assets of the company. Whereas founder shares will have subordinate rights. So first the preference shareholders will be paid, and whatever remains is paid to the founders. In many cases, as I said, the investment happens in the form of convertible preference shares also, or convertible debentures also, or something called convertible loan. These are a form of investment that starts out as a loan, but it has a provision or a potential to be converted into equity shares later on. The valuation can be decided at the time of the loan, or it can be decided later on also, depending upon the negotiation that happens between the company, the startup, and the investor. Also, investment happens in multiple rounds for startups. So generally, there is a pre-seed investment, then seed investment, as the name goes, right? Seed investment, pre-seed investment looks at converting idea into some kind of a commercial product or service, which can be offered to customers who pays for it, and there is some kind of a sales happening. Now, when the sales starts happening, there is a series A, B, C, and such rounds of investment, generally attracting venture capital funds for investment. It is also possible that, with each round, companies or startups valuation may increase, or there is a decrease in the startup valuation at some round also. So this happened with Flipkart in the year 2016-17, when Flipkart was valued, let's say, around $15 billion. There was a round in which its valuation was lower to $10.5 billion. This is a fundraising round where the valuation of the company declines. This is called a down round. There is also a term called capitalization table, which provides everyone who is concerned with the company or planning to invest in the company with a percentage of ownership list. Who owns what percentage of shares? I will show you pre-money and post-money cap table also later on. Investors also expect to earn generally very high internal rate of return, or IRR. This is a measure of investors' return from a startup investment. So early stage investors generally look for return of at least 30% for taking very high risk in startup investment. Investors also receive stock options or warrants, which are allowing them to buy more ownership at a later date, but at a predetermined value, generally a lower value. So if you and this kind of investment happens in larger companies also. You may be familiar with Adani is taking over Ambuja and ACC Cement, and there is a provision. They are planning to issue warrants to Adani investment companies so that they can infuse another 20,000 crore in these two companies, so as to double their capacity in next 5 years, capacity of cement production in next 5 years. So warrants, stock options, these are instruments which allow infusion of fund in the form of equity by the owners of the company at a later date, but the value is decided today. The private stock that we talk about, private equity, rarely pays dividend. So the only way of exiting is through liquidity event, and only way of earning return is in the form of capital gain. When the price of the share increases, that's the way of earning the return. Also, for employees, startups provide or generally create a provision for stock option pool, which is part of some future compensation arrangement with some of the key employees, right? Infosys, Wipro, and many other companies had offered, even HDFC Bank had, HDFC Limited had offered stock options to their early employees who had joined them at a very early stage and who had risen to become the key employees. This stock option pool also is listed in the cap table. So the question is the value of warrants or stock options limited to the total investment? What is the total percentage of warrants on total investment? I'm not able to understand this question. See, warrants or stock options, they are not limited to total investment. They are issued for attracting new investment. So a company may be having, let's say, paid up capital of 1,000 crore. It may issue warrants so that in future, another 500 crore can be brought into the company as a paid up capital, and paid up capital increases from 1,000 crore to 1,500 crore. So at what value the shares will be issued is decided pre-hand for warrants and stock options. And the buyer of the warrants and stock option also has to pay some money to buy this. I hope, I have answered your question. I hope, because I think the question was not clear. What I answered, what I understood the question is. How are convertible loans different from warrants? Okay, so convertible loan starts as a loan. It's a debt. Then it gets converted into equity shares. Whereas warrants, they are not considered as loan. They are issued at a very low price. So for example, if company shares are trading at 2,000 rupees, warrants can be issued as small amount as 50 rupees. But when the warrants are converted to equity, the owner of the warrant, the buyer of the warrant, may have to pay, let's say, another 2,000 rupees or 2,200 rupees or 1,800 rupees to buy new shares of the company. So company gets 50 rupees when warrants are issued, and when shares are issued against those warrants, company gets another capital for the same. Whereas in case of convertible loan, there is a principal of the loan. Let's say 1,000 rupees is the principal of the loan. And when this loan gets converted into equity, the company does not need to pay back the principal. But till the time the debenture or the loan gets converted into equity, company has to pay interest on that. In case of warrants, interest is not required to be paid. Now, when investment is attracted in the form of equity, investors may also insist certain terms and conditions while investing. Now, these terms and conditions are called covenants in legal parlance. Now, these covenants or the terms and conditions may pertain to having a board seat on the board of directors. So the investor may say that he may nominate or he himself may become a director of the company. There also may be a covenant asking for control of certain management decisions, recruitment of certain people, or veto over certain business decisions. The investor also may insist for a right to invest in later rounds. So there may be an investor who invests in a startup in the seed funding stage, and he may insist that he should have a right to invest in, let's say, Series A funding whenever the company raises that, or Series B funding whenever the company raises that. Investors also look for protection against dilution if certain milestones are not reached. So investors generally ask for a milestone in terms of, let's say, the startup will achieve certain sales or reach out to certain number of customers. And if those milestones are not achieved, it is possible that in subsequent rounds, investor would not allow his stake to be diluted. Journey of a typical startup, of financing cycle for a typical startup. Look at this red line. This is the line which is presenting revenue of the company, the sales of the company. And corresponding to that, what kind of financing happens at which stage. So you can see from three different colors, the seed capital or early stage financing, then growth stage financing, and then IPO, which is a later stage or mature stage financing in the world of startup financing cycle. Look at this red line. This red line is nothing but the revenue. In the initial stage, company doesn't have any revenue. There is a lot of expense on working for the idea, converting the idea into a product or a service. And this time, maybe anywhere from 6 months to 3 years. And for some ideas, especially in biotechnology domain, it may take longer than that also. It may take, even 10 years for the product to emerge or a service to emerge and start solving problems of patients or customers or government or the businesses. Till that time, there is a huge cash burn. And till that time, there is no revenue, only expenses. This is what is generally called the valley of death. If financing is not arranged during this phase, startup will not survive. And who finances a business in this phase? Generally, financing at this stage happens first. Apparently, the founders finance the business. Then the founders reach to their family members, their friends, so that they are the other F2F, right? FFF. They apparently get convinced, they have faith in the founder's ability. So family members, friends, and sometimes even fools, they join in investing in the business. Then there are angels, angel investors. The name is very, very interesting name, angel investors. Why are they called angel investors? What is their reason? What is their rationale for investing in a startup at a very early stage and at a very high risk stage? They provide seed capital. So the question is, why would somebody who is not a friend of the founder, who is not a family member of the founder, who is not a father of the founder, would invest in a business? Angel investors, they are individuals who are driven by passion to support technology, innovative business ideas. Why would they like to support this kind of technology innovations? Because they themselves are generally first generation entrepreneurs. This is a very important word, right? Angel investors mostly are first generation entrepreneurs. They were the first people in their family to start a business based on their ability. They got funding, or they did not got funding, but somehow they had a commercial success. Hence, they have been rich, wealthy individuals after success of their business. Now they remember their struggle in early stage of their business, and they would like to support people, startup founders going through similar phase. And they would also like to take risk as well as share rewards. So that's why they invest at a very early stage, at a pre-seed or seed stage in a startup. Generally, the investment amount ranges from anywhere from 40-50 lakh to, let's say, a few crores. This is their capacity, this is their ability to invest in a startup. What happens with this early stage funding for a business or for any startup is that it enables the startup founder to work on the idea, technology innovation, and convert it into a commercially viable product or service. Once the startup sees some kind of a revenue, for let's say once the startup has revenue history of 6 months, 9 months, 1 year, venture capital funds would be interested, will show interest in investing in those startups. This is the time when the company is showing revenue, but not necessarily profit. The revenue is growing fantastically at a high rate. Look at the slope of this line, right? Between, let's say, break-even point to the mezzanine financing. The slope is very high. That means with each passing time, the revenue of the company is increasing at a very high rate. So if I give you an example, between the year 2010 to year 2014-15, Flipkart attracted a lot of investment from early stage investors, angel investors, their family members, both the Bansal's family members and some private individuals also. But once they cross that revenue positive side, lot of VCs invested into it, including one of the largest venture capital fund of the world, Tiger Global, invested into it. And in this phase, if you look at the phase from 2013 to 2018-19, every year Flipkart's revenue was getting doubled. So in this 5 years period, its revenue actually increased by 32 times. So if you look at 2 to the power 5. Now, in this time, they raise a lot of capital. At every stage, there was a dilution for the owners, the Bansal, Sachin and Bindi Bansals. At every stage, new investors were coming. At every stage, there was a increase in the valuation of the startup, except one stage when there was a down round also, as I said. From 15 billion, their value declined to 10.5 billion. What were the investors banking on this? They were banking on more and more Indians coming on 3G mobile telephony, and they forming a habit of buying online, and Flipkart creating an infrastructure, creating capabilities to deliver products across India. So at one point of time, you will be surprised to know 3 years ago or 4 years ago in 2018, Flipkart recruited 24,000 delivery persons across India. One of the biggest recruitment was happening in Flipkart in India in that year. Even TCS Infosys was not recruiting so much. So this is the stage where revenue is growing so fast, profitability is still not there, but considering the capabilities that the company or the startup is developing, venture capital funds would be investing a lot. Now, beyond this stage, once this stage is crossed, apparently the company's revenue would be growing, but the growth of the revenue will start declining. This is the stage where company may be thinking of coming out with an IPO, which happened with with Zomato, Nykaa also, right? They also like to look at the market conditions for IPO, or they may go for secondary offering. This is what happened with Flipkart. Barring few venture capital investors, PEs who had invested in Flipkart, there was a huge exit, and Walmart acquired the company at a valuation of, I think, around 18 billion or so. This is the stage where secondary offering, Walmart's buying shares from earlier investors, venture capital funds, PE funds, and even founders, was a secondary offering. It is a secondary market transaction. Whereas in case of Zomato, they came out with a public market transaction. They found that the market is fantastically high. They can sell the shares at a very high price. So they thought of taking that opportunity and came out with an idea. This is more of an abstract through a picture. If I put more in terms of numbers and the somewhat more details, at pre-seed stage, there is barely an idea. There would be a rough business plan. The investors would be family members, founders, or founders may be bootstrapping their business. Nowadays, government grants is a fantastic source of funding at this stage. A lot of state governments are giving grant. Central government also through incubators is providing grants or early stage pre-seed investments in the form of equity, micro equity, like 25 lakh of investment or 50 lakh rupees of equity investment at a pre-seed stage to startups. Generally, at this stage, there is no external investor. So there is hardly any dilution. Grants, there is a non-diluting. Micro equity, dilution would happen at, let's say, at the most 10%, not more than that, right? Incubators, if they take equity, they take equity less than 6-8%. The returns expectation at this stage is anywhere around 40%, 1% to 40%. At the seed stage, prototype is developed. There is a proof of principle of the technology innovation, but there is hardly any sales. At this stage, angel investors are there to fund. Government grants are also available at this stage. Possibly a small local VC also would be there. And the return expectations are similar, 20 to 40%, right? Again, there is no thumb rule, right? There may be a discussion, negotiation, return expectation may vary. Dilution, when you reach out to an angel investor, generally would be less than 30-35%. Angel investors would not like to take too much equity from the startup founders, because they know that if they take, let's say, if an angel investor takes 70% equity from a startup founder, he knows that the startup founder will lose all the motivation because his own stake has come down. And once he loses the motivation, the founder loses the motivation, the returns to the angel investors or other investors would be jeopardized. So they will like the founder to lead. They will like the founder to stay emotionally, financially, economically invested in the startup. At round A or Series A funding, there is a development of the product which is nearly complete. First trials with customers are happening. At this stage, super angels who have a capacity to invest in large amount or early stage venture capital funds would be investing. They expect return of around 30%. Anywhere in addition to 25%, they are expecting the return. The returns expectation is also linked with returns from equity markets, stock market, right? If the returns from stock markets are high, returns expectation here also would increase. In Series B, there is a sales happening, customers are there, and the company looks at the first growth phase. At this stage, venture capital funds, institutional investors would be investing. Large PE funds would be investing here. Start investing, taking notice, looking investment returns of around 30%. At subsequent rounds, Series C or D rounds, there is a sufficient fund raised to support the growth of the company and bring the company to a situation where the company is at a cash flow neutral stage. That means there is no cash burn. Some kind of a profit starts coming up and the company has a positive cash flow, or at least no cash outflow, large outflow. At this stage, late stage VCs. So if you look at VCs also, they specialize in investing in various stages. They also specialize investing in various sectors. So there are some venture capital funds which invest at a later stage, some funds which invest at an early stage. So these funds, VCs who invest in Series C, D or subsequent round, they invest large amount, they invest at a later stage. Their return expectations are lower. So if you look at it, the early pre-seed investors, they generally get the base returns in terms of IRR. Subsequent rounds, the risk of the investor also gets reduced because at each stage, the startup is proving itself. It's proving its business model. It is proving that they can convert the idea into product and the product can be sold to the customer and customer pays for it. And sometimes the customer gets hooked to their products or services, and he keeps on paying again and again, right? That's why the risk gets reduced in subsequent rounds of investment. Startup investors in subsequent round gets lower return compared to investors at the early round, because they are the ones who take the greatest risk. And then there is something called mezzanine financing. Mezzanine financing is financing before the company goes for IPO or the startup gets acquired. It prepares the startup for IPO or acquisition. Generally, large private equity funds, PE funds, invest in this at this stage, and their return expectations are in the range of 15 to 20%. So this is how it works out in terms of various sources of financing, which are linked with the stage or round of financing, and at what are the generally the milestones that startups should be expected to achieve, and what are the return expectations for the investors. This is when we are talking about scalability, which parameter do you like to see in the business? Scalability means, can the revenue be increased without having more employees, without investing more in the capital asset, or without requiring more money? If that is done, right, if I have, let's say, 100 crore turnover with 100 employees, and I can achieve 200 crore turnover with 105 employees, that's scalability. But if I need 200 employees and if I need to double my investment for 200 crore turnover, that is not scalability. That's a linear growth. Can startups use CCPS as investment instrument more than once, or it is only for, no, it can be used more than once, and it is generally used more than once. I have a product. If a website will not use, then can be fined by law, or who can be the base investor? I'm unable to understand this question. So you can be more detailed, perhaps. One thing I wanted to show you in the timing that is available to us is something called pre and post money cap table. Look at this. Okay, one question is sector relevant strategic investment a real help for startup? Sector relevant. So what happens is, many angel investors and VCs, they prefer a particular sector based on their own expertise of analyzing sector, based on their input in their sector, based on their ability to make startups successful in that sector. So sometimes sector is relevant. So you have to approach an angel investor or a VC if he is a sector specific investor. Find out which investor is appropriate for you and then reach out to him. Okay, let me quickly give you an idea about this pre-money cap table and post-money cap table. As I said, pre-money is a situation which gives you idea about the value of the company before the investment is attracted or investment is brought into. And the post-money is when the investment is done. Look at the left-hand side. This would be a typical pre-money cap table for a startup at the beginning, right? 45% is owned by founder A, 45% is another 45% is owned by the second founder B. And at the very stage, they have provided 10% for the option of the employees. At this stage, let's say the value of the company is only $50,000 or 50,000 rupees, and 1 million shares has been issued. So out of which 450,000 shares are for founder A, 450,000 shares are for founder B, and 1 lakh for the employee stock option pool. So per share valuation here would be 5 paisa or 5 cents. Either way you can see it, right? Company may be at a very early stage, just an idea, and there is a company created, a legal entity created. Now, let's say 6 months passes, both the founders work on this idea. There is a potential, there is a possibility of converting this idea into a fantastic product or service for which there is a very good market. Because of this possible success and 6 months of effort of the two founders, let's say there is an investor who is interested in investing in this company. Now, what happens is the company needs to raise, right, another fund. Let's say the company needs to raise 5 lakh rupees or $5 lakh, out of which the investor agrees to provide 4 lakh, and the remaining 1 lakh will be invested together by founder A and B. They will take the remaining investment. So what will happen is, earlier, and the share valuation is decided is $1 per share. Earlier, the share price was 5 cents. Now the share price has increased by 20 times, from 5 cents to $1. So the external investor subscribed to 4 lakh new shares, invests $4 lakh. Both the founders bringing 50,000 each, they subscribe to 50,000 shares each, and they pay $50,000 each. Together, $5 lakh are raised for this company. Now the valuation has changed, right? From total valuation of 50,000, it has increased to 1.5 million. Our share price is $1. And if you look at the ownership stake, earlier it was 45 for both the founders and 10% for the option pool. Now it has changed. Option pool remains unchanged at 1 lakh, but the number of shares has increased to 1.5 million. So the stake declines from 10% to 6.67. Founder A, which had 4,50,000 shares earlier, subscribed to 50,000 more shares. So he has 5 lakh shares out of 1.5 million. So his ownership stake is 33%. Same is the case of founder B. And the investor who subscribes to 4 lakh shares will be having 26.67% stake in this company. So this is the post-money cap table, where $5 lakh of investment is raised. Company valuation changes from 50,000 to 1.5 million. Or share price jumps from 5 cents to $1, 20 times. Right. So this is what I wanted to discuss in the time that is available to me. I will be happy to take questions more on the cap table also, as well as the financing that we are seeing.
Thank you, sir. I think the cap table is something which will definitely give more insights, because the previous slides, everyone was looking at a little bit of theoretical concepts coming in place, and this now fits into the exact model. So I'm sure this is just the start to the questions and understanding the finances as well. I will just reiterate the kind of audience and participants we have come from all backgrounds. So someone who has picked up initial funding to someone who's just building on an idea stage. So
right.
For them to know that this is the investment questions and the finances they have to have in place, and also gives you a growth trajectory. I think it does give an overall perspective on the financial statements as well. Any further questions, participants, please feel free to ask in the Q&A. We have the last 5 minutes to do that. Post that, we will be sharing the presentation as well as the recording on our YouTube channel and social media channel. For anyone who has further questions, please email us at info@impunjab.org. We will be helping you moderate and answer for the next session as well. Thank you so much. And thank you yet again, sir, for doing this for us.
Thank you very much for calling me. But I think there may be some questions on cap table, because this is very technical terms. I generally have questions on cap table a lot. So if somebody wants to ask that, I will be happy to take.
I think we have a few questions coming up right
Yes,
away.
yes. So one question is, how much ballpark equity should be diluted at each stage and round of the financing? There is no ballpark number. But what happens is, I can tell you about the angel investment round, right? Seed stage or pre-seed stage. Generally, angel investors do not take very large stake. They generally take around 30 to 35%. They are the biggest risk taker outside your family members, friends in your business. So they will like to take a stake where they can influence the fortunes of the company, not take a very small stake, right? Subsequent rounds, there is no ballpark number. It can be, at every round, there can be 20% dilution, or at every round, it can be 10% dilution also, right? But what happens, one thing is certain, that every round, the ownership stake of founders keeps on getting diluted. So at one stage, their stake will become very insignificant. This is what happened to both Sachin Bansal and Binny Bansal. Their stake becomes so small, and the company becomes so large, that the PVC investors felt that it is necessary to bring a professional manager, professional CEO, and they asked Bansals to step down. And the Bansals also professionally stepped down also. And Kalyan Krishnamurthy is the CEO of the company, Flipkart, who is running the show now. This is happening because apparently the stake dilution happens, right? How share price is decided? Any particular things to keep in mind? Share prices are decided based on the kind of value that is offered by the startup, leading to the valuation of the startup. Valuation decides, valuation divided by the number of outstanding shares leads to the per share price. Okay, about the unit economics, I think it requires a separate session. I will not be able to address unit economics in the 2-3 minutes that we have right now. So perhaps later on,
so
we
that
can talk about
another reason to do another session as well. But for the larger audience, if you can just tell in a gist, like how do you define unit economics, like a definition, and then we probably, basis the interest of the audience, we will definitely schedule another masterclass on just unit economics. And
so unit economics looks at what is the lifetime value of a client for a business, and how much should the business spend to acquire that client. If this lifetime value is more than the cost of acquiring the client, the unit economics would be positive. This is what any business should be targeting. So if I give an example, if I become client of Uber, what is the lifetime value for Uber looking at me as a client? And what should Uber spend to acquire me as a client? This is the unit economics is all about, in a very short way, a short form. Why does the option pool get diluted? Why not just the founder's equity? Option pool again remains same. The number of shares has been kept aside, 1 lakh shares only for the employee option. That's why it gets diluted. Also, option is generally offered to early employees and key employees, not to all employees, and not employees joining at a later stage. So like Infosys, I don't think is offering options to employees who join now, but they were offering option to employees who joined in 1990, because they were the early employees, they were the key employees. There's a platform named as Tyke to raise the crowdfund. Can you tell me about it? Crowdfunding in India is not legal. It is legal in US. So you may have you heard of these platforms like Indiegogo, Kickstarter, Tyke. They allow you to raise fund from crowd. In India, it is not legal, right? In US, it is. How does one justify the valuation when pivoting from one sector to another? Because there are certain sectors where it is easy to create value, right? So if I tell you what does it create, require to make a product like Zoom through which we are connecting? It's a software application. Few people would sit together, apply, let's say, work for a couple of years, and it is ready. Subsequently, sharing this product can be a phenomena, right? It can be shared very easily. Anyone can download it and start using it, and Zoom can start making money. But just think about cement. What does it require to produce one bag of cement, and what does it require to deliver one bag of cement to a client across India? So apparently, some businesses would be having higher valuation because of the sector, and some businesses would have a lower valuation because of the nature of that business. Share the factors. In fact, while giving this example of Zoom, I gave idea about the factors which lead to investors' decision of investing in a certain company. How quickly the products can be sold. What is the cost of production? What is the level of engagement of the customer? How repeatedly the customer is going to be engaged with you? What is the customer going to pay you throughout the life? These are the factors which decides the value of the company. What is the ideal LTV or to CAC ratio? There is no ideal, but 1-to-1 it should not be. I can tell you that. It should not be 1-to-1. It can be, it has to be positive for commercial success. LTV should be greater than CAC, but greater than by a few multiples for the business to gain something from the client. Otherwise, the business pay to the client.
So would 3:1 be a good ratio, or it also depends on the sector and the
3:1 is the minimum that you should be looking at it. The higher, the better.
Sure.
1-to-1 is highly detrimental, harmful for the business. I have named factors which can affect investment decisions. Most common method of valuation, something called discounted cash flow method is the most common method of valuation. But in startup investing, a method called venture capital method of valuation is also used. You can please give a search by these names on Google, and you will get some readings available: discounted cash flow valuation and venture capital method of valuation. I can suggest one book to read. If you want to read Peter Thiel's book 0-to-1 if you are interested in reading. The most important thing for any entrepreneur that I advise is go to the market as early as possible. Don't spend too much time in developing the product. Don't think your product, you should go to the market when the product is perfect. Go to the market with imperfect product also. Market will give you opportunities to work, improve your product, and reach to them early. So going to the market is most important. I think. Yes, you will be able to get access to these videos also.
Thank you. With this, we will wind up the session. We're just 2 minutes beyond it. Thank you so much, sir. Thank you for your time. I think
thank you for inviting me.
By far, it's our privilege, sir. Thank you so much. By far, this has been the most engaging sessions in terms of Q&As, and you picked it up right at the time when the situation or the content was picked up. So we appreciate the moderation as well as the learnings you've imbibed with the overall audience. We will definitely, with the feedback coming in, we will definitely be scheduling another one, especially on unit economics. I think that's been everyone's thing. We will also be having you in person in one of our engagements as well. So we look forward to seeing you at Innovation Mission Punjab. And we will definitely be discussing this with the startups as well and see how we can incorporate the engagement both virtually and physically. Thank you yet again for your support. See you here again soon.
Thank you so much.
Thank you. Have a nice day. Thanks, everybody. Thank you for participating.
Thank you.
Stay tuned on our social media channels. Everything will be updated. You will have the recorded video hosted on our YouTube channel. For any questions, please mail us on info@IMPunjab. and you can follow us on the rest of the channels. Thank you.